Welcome to Mistine Deep Dive. Today I am breaking down YMAX. This ETF is unique because it is a fund made up of other funds. Think of it like a basket of baskets. YMAX holds several YieldMax income ETFs that each use covered call strategies on high growth or high yield assets. These assets include well-known names in technology and crypto like Tesla, Nvidia, Bitcoin, and more. The idea is to layer monthly income from different covered call ETFs so as to create a powerful income machine. But this tool is not without complexity or risk. What is YMAX? YMAX stands for YieldMax Universe Fund of Option Income ETFs. It uses a fund of funds structure by investing equally in all available YieldMax covered call ETFs. Each underlying ETF owns a major asset and overlays a synthetic covered call strategy. That means it holds exposure to the underlying asset using derivatives rather than buying the actual asset. Then it sells call options on it to generate income. This income is passed up to YMAX, which then distributes it to investors. When new YieldMax ETFs launch, they are added to YMAX at equal weights during a monthly rebalance. How YMAX generates income. The process is layered. First, the underlying YieldMax ETFs sell call options on their assets each month or week. Those premiums generate income inside each fund. Those funds pay a monthly distribution to their shareholders. That distribution is what YMAX receives. Then YMAX collects all those incomes evenly across its holdings. Finally, YMAX distributes the income it receives on a weekly basis to investors. Recent income and composition. YMAX has a recent distribution rate of around 66% per year based on its most recent payout. Its SEC yield, which excludes return of capital, is closer to 89% per year. Its most recent distribution in early June contained about 73% return of capital and 27% actual income. That means most of the payout is return of capital, which lowers the fund value but delays the tax bill until you sell. Performance versus index. Since launching in January of last year, YMAX has returned 27% in total, which annualizes to about 19%. In comparison, the S&P 500 index has returned about 26% over the same period. While YMAX has matched or slightly outperformed the index when income is included, its NAV or price action has been volatile. In the first quarter, it dropped over 10%, while the S&P fell about 4% monthly payouts. YMAX pays weekly distributions. Recent weekly payments range between 14 cents and 21 cents per share, depending on market conditions. While this frequency can be attractive, it means you need to track these payouts and understand that the caps on upside can create erosion. Price participation risk. Covered call income comes with a trade-off. You limit your gains on the upside if the underlying assets rally. YMAX caps its participation in price gains while retaining full downside risk. That means its NAV can drop just as much as market index but will not rise as much when the market surges. It did lag the S&P in strong rallies and only matched with income included, but during drops it provided less cushioning. High expense structure. YMAX has an internal expense ratio of about 1.28% annually. This includes costs from the underlying funds and its own management. These fees reduce net returns. For example, with $10,000 invested at 1.28% would cost $128 per year before income even begins. You pay for the structure with your returns. NAV erosion and return of capital. Most of YMAX distributions are return of capital. This lowers the fund's NAV over time. Frequent payments mean NAV declines by the distribution amount each week. With high return of capital portions, there is a risk that the asset value shrinks faster than the income can replenish, especially if underlying incomes drop or markets turn volatile. Complex structure and risks. YMAX uses synthetic covered call strategies on multiple underlying assets. Synthetic strategies involve derivatives and collateral. There are risks from option market volatility, counterparty exposure, and liquidity. There is also risk of tax code loss harvesting strategies that trade assets to capture tax losses. All of this makes the fund complex tax implications. YMAX issues distributions that are mostly return of capital, which lowers cost basis and defers taxes. Its underlying funds may use Section 1256 options, which get tax treatment like 60% long-term gains and 40% short-term gains. Taxes on distributions plus tax events when selling can be complicated. You should talk to your tax or financial advisor. Who is YMAX for? This ETF is for experienced investors who want big income and can stomach high-risk complexity and tax management. You need to understand layered covered call strategies, return of capital, and NAV erosion. It is not for passive investors seeking long-term growth or simplicity. If your goal is current high income and you are comfortable with coupons and complexity, YMAX could be a tool in a small part of your portfolio. My meter rating: income 10 out of 10, risk 9 out of 10, simplicity 2 out of 10, long-term safety 3 out of 10, upside potential 4 out of 10, total score 5 out of 10. Is YMAX right for you? YMAX is powerful and unique. It delivers high weekly income, but at the cost of capped upside NAV losses, complexity, taxes, and volatility. If you want a fund that pays regular cash and you know what you are investing in, it may be worth including in a risky income bucket. But if you prioritize growth or simplicity, there are better options. Final thoughts. YMAX is a bold experiment in using covered calls across multiple strategies. It can pay well when markets are neutral or volatile, but it is not a set it and forget it ETF. You need to monitor income reliability and NAV erosion, underlying strategy changes, and tax consequences. Know what you own and how it works. If it fits your income goals and you accept its risks, it may be a useful tool, but only if it aligns with your plan.